What's up, everyone? It's Scotty with Money Investing. So Jamie Dimon from JP Morgan is now seeing more rate hikes from the Federal Reserve and expecting inflation to continue to be stickier than originally thought. So hope you guys are doing great and are having a great day. Make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. Link to our Discord and Patreon is going to be down below if you're interested in joining us, and of course getting access to that 16% annual discount that does expire tonight. So after midnight, it is going to go away forever. So link's going to be down below if you're interested in joining, and of course getting access to all the alerts, buy and sell alerts, options alerts, trade ideas. Right now we do have a swing trade idea on TMF, which is a little bit of a bond price ETF with respect to the 10 and the 20-year treasury yields. And of course got several covered calls already sold out on, of course, Tesla, Meta, on all these companies. So again, link's going to be down below if you're interested in joining. So this right here was the actual report, and Jamie Dimon then mentioned about the financial markets, basically says that there is going to be a deal that's going to come together for the debt ceiling, right? So for debt ceiling defaults, there is going to be a deal that's going to come through. He said if it wasn't the case, he wouldn't even be there doing the interview. He's, by the way, in China, in Shanghai at the moment. So obviously it's got to get through a couple of votes in Congress, and I think that's going to be today, and our people are pretty comfortable it will happen. And something I've also mentioned in my yesterday's live stream, I specifically mentioned that I also believe that this is going to go through, it's going to pass in Congress on Wednesday, which is again today. And that's one of the reasons why I did end up taking a position in TMF yesterday, and I'm expecting a little bit more upside here moving forward. So right now we are gapping up once again a little bit over 779, closer to 780, as the yields are pulling back down. Once again, you can see the yields are rolling over, right? They're down almost 1%. We're back under 3.7% for the 10-year yields on this entire report, of course, that we are going to potentially see this debt ceiling debate finally put to rest, and we are going to see it pass in Congress. Of course, time will tell. And House of Representatives vote on the U.S. debt ceiling deal expected later on Wednesday after narrowly clearing the Rules Committee despite the Freedom Caucus revolt. Now, he also mentioned that banks has for years made clear the default won't be good for the financial system or the U.S. economy, which the rest of the world relies on. And quote, I wish one day we'd get rid of the whole debt ceiling thing. When asked about interest rates, and this is where things get very interesting, he said investors do need to be prepared for perhaps a less smooth ride, as the Federal Reserve may not be done with their inflation fight just yet. While the Fed has potential cause or right to pause at this point, after 500 basis points worth of interest rate hikes, he said it's possible they're going to raise a little bit more. When talking about inflation, he says inflation is kind of stickier, and I think people are coming around to that, which means rates may have to go up a little bit more, and people should be a little prepared for that. And the other thing is, I think I'd be a little bit prepared for this volatility that might very well be created by quantitative tightening, because we've never really seen quantitative tightening in the last 15 years, he says, which we've now had for the better part of 15 years. You're basically seeing quantitative easing, and now you're going to see quantitative tightening. So very, very true. We have pretty much been in this environment of quantitative easing for a very long time because inflation was so low, and now we're kind of in this QT environment. And I know the markets are pricing in interest rate cuts, and markets are pricing in significant reduction in inflation, but it's only one of the many possible outcomes, one of the very many probable outcomes that could happen in the market if inflation stays sticky, it stays higher, and not to mention if the Federal Reserve also decides to raise rates a little bit further and stay there for longer, which, by the way, the average months, the average time between a rate cut after a rate hike is about 7 months, right? 6 to 7 months is that timeline. And he also mentioned that the effects may be a little bit harsher than people expect, but hopefully we'll get through all of that and be okay. He also mentioned that some of the regional banks are reporting some very good numbers, and the banking sector, the banking system, is in pretty good shape, which with the results showing very good numbers from regional banks. And then finally talking about how the banking sector needs to remain vigilant about the higher interest rates in light of the role they played in the precipitating in the recent crisis. I think we're over this part of the crisis for the most part, but rising interest rates, if they get high enough, it can rear its ugly head again, which obviously is going to have that lag effect, because if interest rates keep going higher, things can get even worse than what they already are. And that's one of the things I feel like we're kind of like putting a blind eye to, because everybody is kind of, hyped up on artificial intelligence, on tech stocks, and we're starting to kind of, really get ahead of ourselves a little bit considering how much momentum, how much rallies, and how much optimism we've seen from these companies. And there's nothing wrong with that, but it's just kind of understanding that, okay, there's a whole different, crises going on with higher interest rates and inflation, and of course, not to mention the banking sector as well. And he also mentioned that I like the fact that Janet Yellen, the Secretary of Treasury, President Biden, and the National Security Advisor, Secretary of State have been talking about de-risking. And of course, you're not going to fix these things if you are just sitting across the Pacific yelling at each other, and eventually this will get resolved. So this right here is where the markets are. Now we are at a 65% probability that we're going to absolutely see a rate hike in June in less than 14 days now, 15 days. We're going to see another FOMC meeting, and the rate hike of about 25 basis points is what's expected for us to get up to 5.25 and 5.5%. And then the market's pricing in, we're going to stay there for 2 more months or 2 more meetings, or really just 3 more months, and then start cutting rates starting in November. Now, my expectation, as I've already mentioned before, that I'm expecting as inflation continues to be a little bit more stickier, and again, we're going to find out between now and November, if inflation doesn't come down fast enough on the back of shelter prices, I do expect this to change in the next few months as well, as we have already seen, right? Markets were expecting a pause this June meeting, and now they're pricing in a rate cut. That means they have become a little bit less dovish and more towards the hawkish side with respect to interest rates, and that's the discrepancy we've talked about on the channel several times over. And I do expect if inflation remains to be sticky, if it doesn't come down fast enough on the back of shelter prices, which are taking their sweet time to really come down, then I do believe that this timeline will once again shift a little bit farther out, meaning that this number right here will go up to here, this will go up here, this will go up here, this will go up here, meaning that we will move more towards the right side, which means more longer pauses and less cuts in 2023, and of course, not to mention 2024 as well. So that's where we are right now. Let me know your thoughts down in the comment section below. Yields are rolling over. Volatility is a little bit more on the elevated side on the day, up close to 3%, but still trading under 18, so still trading under 20 for the most part, getting rejected at those levels a couple of times. And of course, we are seeing the markets here, once again, very much with narrow leadership, pushing higher. S&P right at over 4,200 as of the time of this video. And of course, right now, pre-market, we're gapping down just a little bit. So hope you guys enjoyed this video. Let me know your thoughts down in the comment section below. In under 15 days and 2 weeks, we've got the next Fed meeting with the summary of economic projections. So SEP is also going to be coming out, which is going to be very important for the market as well, because that's really going to tell us a little bit more about what the future looks like with respect to interest rates as well. So hope you guys enjoyed this video, found it helpful. If you did, make sure that you drop a like. Don't forget to subscribe to the channel if you're just joining us for the first time. The link to our Discord and Patreon is going to be down below. Let me know your thoughts down in the comment section below. What do you think or believe the Federal Reserve is going to do with interest rates? As always, happy investing, and I'll see you all in the next video.